Boy, inflation has been crazy right now, with inflation as high as 9%, and we're seeing that come down quite a bit right now at about 3.5%. But what's resulted is some of the highest levels of household debt that we've seen ever. Right now, there is $17.1 trillion in household debt, and of that, over $1 trillion is currently in credit card debt. So in 2020, that was 2.5 trillion less than it is right now. And so in trying to keep up with inflation, Americans are continuing to go in debt and really feeling the pain. So whether it's car payments, credit cards, student loans, mortgage, HELOC, all those things, in addition to the fact that you probably want to live your life. Your kids probably, might play soccer or football, and all of those sports costs. It's always great to be able to eat out and spend time with the family. And I'm 100% for that. We love our family time, and it's all really expensive. But right now you might be looking at it and saying, boy, I am getting choked out by all this debt, and starting to look for some solutions on what to do to get out of this high monthly payment that you're paying. So I wanted to share my screen here. So as we look at what national averages are, I wanted to take a moment and talk through with you what the average person is doing and what you can do about it. So first of all, this is a blended rate calculator. And the blended rate, what it does is, people say, oh, my rate on my house is 3.25 and it's really awesome and I don't want to do anything with it. But what they're not taking into account is all the other debt and what that debt is doing to them. So a car payment right now, we're seeing at about 5.5%, 5.6% for say $35,000 is somewhere between $670 and $7.25. When you're looking at your credit cards, average national average is 20.93. If you have $50,000 in a month in credit cards, you're probably paying somewhere around $14.50 a month. Student debt, if you still have that hanging around, average about 7.64 between federal and private student loan debt, $339. And then your house payment. So if you currently have a house payment, say you're in an FHA loan, it's the first house that you bought, you're paying principal, interest, taxes, insurance, your rate might be 3.5%, and you might be paying somewhere in the $2,817 a month. So that means your overall blended cost is $5,276. So that's your cash flow. Well, your cash flow is what you have left, but your cash that you're paying out in expenses is $5,276, and your blended rate is 5.57. So when you're saying, hey, I've got a 3.5% interest rate, actually what you're saying is, if this looks like you, then you're really paying more like 5.57%. And if any of those numbers are higher, then it could be worse, or it could be better if they're lower. So I'd be happy to run through the blended rate calculator with you. We can run numbers together and see what your blended rate is. But as you can tell, this is a pretty normal picture of what people are seeing. Maybe 30, 50, 75,000 in credit card debt, and that number is continuing to go up. So what do you do about it? Let's talk about an action plan. First of all, you want to get in and look at where your credit is today. So what is your credit score? Better interest rates are going to be able when you have a better FICO score. So we all know about FICO scores. Not everybody knows what makes them up. We'll talk about that down the road. But right now, if you've got a 740, 760 FICO score, you have all of the best opportunities available to you from a loan standpoint. You've got the FHA loan that lets you do on a cash out refi 20% down, and on a VA loan you can do 100% financed. And then with a conventional loan, you're at about the same 20% equity in the property. What if you don't want to mess with that 3.5? Well, first of all, let's take a look at a HELOC, a home equity line of credit. If you haven't had a chance to look at a HELOC, it's like a credit card backed by your house. And so it usually can go up to roughly 80 to 90% of the value of your home. You most likely will need to still get an appraisal, but sometimes they'll use what's called an AVM, or an automated valuation method. and run off of that AVM to be able to determine what you qualify for loan amount in a HELOC. And a HELOC can be purchased high. You can run the balance up, you can pay it down. So depending on what your need is, it's a very flexible tool. The interest rates are running somewhere between 8 and 13% on a HELOC. You've got APR fees are pretty low, so usually APR is somewhere in 9 to 14%. And it's going to be dependent again on your FICO score and what you qualify for. The other loan that you can be looking at right now is a cash out refinance. And so you can use FHA, VA, conventional for that loan amount. And as I talked about, the percentages that you can go up to, but we're originating a whole new loan. You may or may not have to get an appraisal, and you will run credit and determine what you qualify for. So the interest rate might be higher. While you still have a higher interest rate, your overall payment a lot of times are dropping from $500 to $1,000 a month. So the reason why you do this is a few things. One is your cash flow, so what you have left over afterwards. Second thing that is really valuable about doing a cash out refinance is that a rate and term refinance, when rates do come back down, you're going to get a better interest rate when it's a rate and term, meaning all you're doing, not taking any cash out, you're just paying off an existing mortgage. Well, if you do a cash out refinance today at a higher interest rate, it'll put you in a position potentially to be able to do a much better interest rate once rates go down in the form of a rate and term refinance. Also, doing a cash out refinance will most likely help you dramatically with your FICO score. So because balance to limits on credit cards impact your FICO score, and FICO scores impact how your interest rate is calculated, doing a cash out refinance in the short term to get yourself in a position to do a rate and term in the next 6 to 12 months could really be beneficial long term as far as your loan goes. The other great thing, and it's an ancillary benefit, it's not a primary benefit, but you can skip 2 months payments. So if we were doing a cash out refinance right now, we could do the loan, finish it up in November, have no payment in November, no payment in December, and your first payment would be in January. The other is that you get your current impound account back typically. So if you've got an impound account right now, and even though we're doing a rate and term refinance, in this case we're doing a cash out refinance, you get your impound account back from your existing mortgage. So it's got some really nice ancillary benefits, but we really want to think of this strategically so that when rates do go down in the next 6 to 12 months, you're in a position to be able to take advantage of that, and in the meantime be able to enjoy your holidays and be able to spend time with your family. If you'd like to know what's possible for you, if you'd like to see a blended rate calculator, we can run a soft pull on credit, so we won't even take a hard pull, so it won't even show up on your credit report. We just do an application, pull a soft pull, and we'll put together scenarios with our total cost analysis to be able to evaluate your current overall situation with what's possible in a new loan. So I'd love to help. Call us here in the office. The number's below. You can also direct message me. I'd be happy to talk to you about your current situation, and we're here to help. Have a great day.